30 minutes till the start of trading. I'm Matt Miller.
I'm Dani Burger. Bloomberg Open Interest starts right now.
Coming up, eyeing an exit, President Trump may be willing to end the Iran war even if the Strait of Hormuz remains closed.
U.S. gas prices push past $4 a gallon as investors close out a volatile month for markets.
Plus, M&A heating up this Tuesday morning with Unilever and McCormick joining forces to create a global food giant.
M&A on a Tuesday. What a weird phenomenon.
It's
not even Monday.
And maybe Taco Tuesday
Maybe
as well.
Taco Tuesday. I actually have my eye on another deal that we heard this morning. It's NVIDIA, and Matt, they're investing $2 billion in Marvell as part of a strategic partnership. Something about silicon photonics, something about like data energy transfer that's important for AI.
They're just bringing, I think, as many more into their big AI tent as they possibly can. So
yes, that was much better explained than my poor man's attempt at a Mandeep Singh.
All right, so those shares are up. I'm watching the incredibly confusing combination of Unilever food with McCormick. It will create, no matter how you view it, a condiments and spices giant. Unilever will control, Unilever shareholders are going to end up with the majority of the company, about 65%, including Unilever shareholders and corporate. But they're going to keep the McCormick, Unilever food will keep the McCormick brand, the McCormick headquarters, the McCormick C-suite. So it's like a reverse Morrison Trust, Dani. And as a result, McCormick is down 6.5%, Unilever off as well.
So simple. I don't know what's confusing about that at all. Let's get back to our top story this morning, Matt, and it's the war in Iran. President Trump lashing out at allies this morning, urging them to buy U.S. jet fuel or fight for yourselves in the Strait of Hormuz. Defense Secretary Pete Hegseth also speaking earlier on the latest in the Middle East.
The last 24 hours saw the lowest number of enemy missiles and drones fired by Iran. They will go underground, but we will find them. President Trump will make a deal he is willing. And the terms of the deal are known to them. If Iran is not willing, then the United States War Department will continue with even more intensity.
Joining us now is Wayne Sanders, Bloomberg Intelligence Senior Defense Analyst and retired Army Colonel. Wayne, this from the Wall Street Journal yesterday, saying that President Trump has told his allies that he's willing to end the U.S. military campaign against Iran, even if the Strait of Hormuz remains closed. Yesterday, you and I were talking at this exact time that the president was issuing an ultimatum to Iran to getting the Strait open. It's the mixed messaging continued.
I agree. I think you even see that the U.S. struck Keshem Island, that being one of the areas inside of the Strait of Hormuz. Towards the opening, we had talked about potentially some of the scenarios being that they would seize Karg Island and others with the ground troops. So there definitely seems to be some mixed messaging here. I think that it's still being able to say, hey, look, we can do the following things. And then Iran did the same, right? They have obviously escalated as well, hitting a Kuwaiti oil tanker. So both sides are still trying to position themselves as best they can for any type of negotiating. If they're trying to do that. If not, President Trump, I still think, is looking for an off-ramp.
Is it safe to get on the off-ramp when the Iranians still have maybe 440 kilograms worth of highly enriched uranium? I mean, they have the capability, likely, and the know-how, definitely, to turn that into a nuclear bomb within, 4 weeks?
Yeah, I think that's one of the biggest reasons you saw what happened in Natanz, Fordo, and Isfahan. It's one of the areas why you've seen so much pressure against military targets and production facilities that could do anything to be able to enrich the uranium itself. I think that's one of the areas where it's very difficult when you don't have boots on the ground to confirm or deny any of the strikes and the movement of any of this fissile material that could be turned into that. One of the biggest areas where they were striking were a lot of the missile facilities, especially like the Fatah 110s, which is one of the areas that they were actually concerned, not only from a nuclear capability, but then it can now range if you put that warhead specifically on one of these longer range missiles to reach your the Gulf state partners as well.
All right, retired Army Colonel Wayne Sanders there now, fortunately with us at Bloomberg Intelligence. Looking forward to your research on this. Let's turn now to energy. U.S. gasoline prices climbed above $4 a gallon for the first time since 2022. Joining us now is Bloomberg oil strategist Julian Lee. And Julian, I mean, what would happen to the price of crude if the U.S. decided to, as the Wall Street Journal reported, just leave Iran with, its leadership, I guess its new leadership intact, the regime still in control, highly enriched uranium on the loose, and the Strait of Hormuz, most importantly for your markets, closed?
Yeah, I mean, this is a situation that is orders of magnitude worse than it was a month and a bit ago before these attacks started. We've got 20 million barrels a day of oil that's stuck behind the Strait of Hormuz. Most of that now is stuck in the ground because there's no more ships or storage tanks to put it in. Saudi Arabia is exporting about 5 million barrels a day from the Red Sea. That's up by, 4.5 million from what it was doing before the war. So you've got 4.5 million coming out on the Red Sea, 20 million stuck in the Persian Gulf. The world can't tolerate 15 million barrels a day of oil supply off the market without prices taking the strain and without shortages developing in time. Yes, there are strategic stockpiles. Yes, there are commercial stockpiles. But those are finite amounts of oil. And at some point, if this situation isn't resolved, and if we don't get oil flowing again through the Strait of Hormuz, those stockpiles are going to get drawn down.
I know it's been discussed before, but I think it's always worth revisiting, Julian. Just how big of a disconnect is there right now between paper and physical markets in oil, in crude?
I think there is something of a disconnect. I mean, they are intrinsically linked to each other, but I think that there are certain parts of the world where refiners are finding it physically difficult to find sufficient crude to process, and there are parts of the world where companies that are looking to buy refined products are finding it very difficult to secure some of those specific products that they need, and it seems to be particularly things like jet fuel and diesel at the moment that are in physical shortage in certain parts of the world.
Hey, Julian, thank you so much for your time this morning. That's Bloomberg's Julian Lee. Now, the stock market, amid all of this, has had its worst quarter since 2022. The S&P 500 was positive until the war in Iran began, and now it's down 7% year to date. Let's discuss with Bloomberg senior strategist Jan Patrick Barnett. JP, the longest quarter maybe known to mankind. How are we set up going forward from here?
Well, I mean, if you look just through the trading desk commentary and the analysts as well, frankly, there's so many people said, this was a quarter that was 5 years in one. And actually, if we look at all the things that are moving when we came into the quarter with the discussion about AI disruption and who makes the money, and then we had a pro-cyclical rotation, and now we have a defensive rotation, and now we have all the geopolitics being in the midst of it. I mean, we should not forget that stuff like Venezuela and Greenland also happened in this quarter, maybe long been forgotten by this point. But to your question going forward, I guess we're going to see another, I guess, at least 2 or 3 quarters where we have to work through all of this. We have to work through oil and what it means for inflation and for rates and figure out what it does to the economy. We still have to figure out the AI trade, the winners and the losers. And then we have to figure out how portfolios are going to be positioned. I mean, this quarter was also brutal in terms of people trying to hedge themselves when the Iran war started. But those hedges not really paying off because the grind was super slow and not these steep declines that we have seen a year ago, for example, in the Liberation Day. So all in all, a very difficult quarter that will leave its mark on the year, and that will probably need a bit more digesting going forward.
I was shocked to see a couple of things, JP. One, that Microsoft is down 25% year to date. I would have thought, that's almost a safe haven stock, but it hasn't been acting like it, and neither have any really of the Mag 7 stocks. And then to see that this is shaping up to be the worst start to a year since 2001. Since 2001. That's insane. I mean, Dani was in preschool. So how did it get this bad? I mean, and where are the safe havens in stocks?
Well, I mean, like to the worst start to the year, you can go back even further to 1977 if you want to look at it in terms of how many weeks we had where the S&P 500 posted a gain. Yeah, we all were, I guess. So it was only like 3 weeks. So that's the worst data point here since 1977. I mean, like safe haven it's good that you talk about it because that's also a problem for many, I guess, because there are literally no safe havens at this point. I mean, like like gold and silver have been behaving like a meme stock and are now in a correction, so you can't really use them as a safe haven. Rates are going down because, or rates are going up and bonds are going down, so they are not very useful. I mean, like the dollar is recovering a little bit, which was the most hated trade coming into the year, I would say. So it's like very difficult for people to balance portfolios, to find the spots where they can hide until all this is over. I guess the only spot right now is energy, but if you haven't been on that like 5 weeks ago, then it's probably too late right now. So going forward, a lot will depend on what your view on the economy is. But if your view is that the economy is going to take a hit from all that episode and that the AI trade is far from like being an easy one going forward, then I guess the best way to hide is probably value or the most defensive parts of the market. But you can't expect like big returns from that either.
All right. JP, thanks very much. Bloomberg senior strategist Jan Patrick Barnard there out of Frankfurt. Quick check on what's going on in the markets. Here in the early trade, or in the futures, I should say, S&P futures are up more than 1%, which is, I think, fairly striking as you see oil continuing to either move higher or hold, depending on how you want to view it. I mean, at $107 a barrel for Brent, $103 a barrel for NYMEX crude. And the 10-year yield right now coming down 3 basis points, but still over 430. So interesting setup. Let's get a look at some of the single stock stories on our radar this morning. CoreWeave has raised $8.5 billion from a group of banks and investors to help finance an expansion of its cloud computing capacity.
And then some other deals news on this Deals Tuesday. Eli Lilly is buying sleep drug maker Contessa in a nearly $8 billion deal.
And Biogen will buy Apellis for more than $5 billion as it expands kidney drug offerings. We're going to talk about all of these pharma deals, all of these healthcare deals with Sam Fazeli later on in the program. And coming up, a lot of deal news around consumer products as well, including McCormick's takeover of Unilever's food business, depending on how you define takeover. We'll explain next. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Delta Airlines has agreed to use Amazon satellites to deliver in-flight Wi-Fi service. The airline announcing in a statement, Amazon Leo internet service will be installed on 500 aircraft starting in 2028. It marks a big win for Amazon's space business as it vies with Elon Musk's Starlink for aviation customers. Of course, a lot could happen between now and 2028. Whoop is now valued at $10.1 billion for after a new funding round, I should say. The company has more than 2.5 million members and was cash flow positive in 2025, with subscriptions increasing more than 100%. This comes as the company considers an IPO in the next couple of years. Catch my interview with the CEO of Whoop, Will Ahmed, at 11 a.m. New York time on Bloomberg Tech. And Unilever is combining its food business with McCormick in a deal worth nearly $45 billion. The agreement will give Unilever and its shareholders the biggest stake over a newly formed global seasonings and condiments giant. Unilever and shareholders will have 65% of the company. McCormick, which its shareholders will have 35%, but it's going to keep the McCormick name. It's going to keep the headquarters. It's going to keep the C-suite. So who's buying whom? Dani, it's an interesting deal.
Let's talk about it and the structure of it with Bloomberg Deals reporter Crystal C. Crystal, can you actually explain just like what this combination looks like? Because as Matt said, it's not exactly the most straightforward thing.
It is definitely not the most straightforward deal. Just to think about it, is that Unilever is thinking about divesting its food business, and it's a business that does not belong, in their opinion, in the whole umbrella of Unilever. So in that regard, like, they are getting rid of a business, while that business is still massive. So they are still going to be delivered, the combined company will be delivering 20 billion in revenue. So just think about that. Even the divestiture itself will make it actually a bigger piece of the combined company than the original McCormick business, even though it will now be named McCormick.
Well, I mean, what's left at Unilever after this? Everything Unilever makes that we know is now McCormick, right? So what is under the umbrella of Unilever?
So now you will no longer see the Hellman mayonnaise, you will no longer see the Marmite, but you will see that Unilever is transforming itself into a pure play personal care player. And food has been a really challenged business, and we've actually seen quite a few strategic review from big food corporates. Some of that is because of the impact of GLP-1, and less so, GLP-1 still does not impact, whether you have to buy laundry detergent, whether you have to buy dish soap. And so Unilever is making a statement that they are now going to be focused on personal care, home care, more so than food businesses.
There does have this feeling of a lot of consumer deals recently, Crystal. I was just looking at the ones we got in about the past couple of weeks. Yesterday, your team reporting on Allbirds being bought by a fund that owns a bunch of different consumer brands. Pernod Ricard buying a Jack Daniels maker. Puig confirming talks with Estee Lauder. What's in the water right now?
Yeah, I think consumer is just going through a pretty challenging period. And I think the really good way to think about it is how these deals are actually years in the making, if not almost a decade. And these companies have been thinking about how to get growth, how to buy growth. Some of them have done smaller deals in the form of tuck-in acquisition. For instance, Estee Lauder had divested brands. They have look at new brands, but then now they're really in the crossroad of having to think about what is strategic and what is transformative, and we're seeing that played out, especially because economy is potentially coming to a downturn, and a lot of consumer companies are feeling the heat from their customers. So Allbirds is a good example.
Well, I was just going to say, and actually this is away from Allbirds, so apologies for jumping in there, but should we make anything of the fact that this McCormick deal, the Pernod Ricard and Estee Lauder, that they're all cross-border deals?
Yeah, I think there is an element of that. I think just globally, food tends to be a pretty global business, as well as apparel and all of those other consumer categories, because they're so brand driven. I think there's also an argument to be said that scale really does matter in this market, and if you can really diversify your customer base, your source of suppliers, those are all very good strategy to have in a market that is potentially coming to a downturn.
All right, Crystal, great having you on the program. Bloomberg Crystal C, breaking the news on deals left and right. You can catch, by the way, the Bloomberg Deals program every Wednesday at 12 noon New York time. That's an hour-long program focused exclusively on M&A.
I've heard it's pretty good.
It's pretty good. I watch it every week. It's interesting because the brands that Unilever will be left with, right. Americans will know Dove, the soap, and may know... I guess Axe. Do we have that body spray Axe here? It's very big in Europe.
Yeah. No, isn't it called? It's like Lynx in Europe and Axe here.
Right. Okay. And then Persil,
but do you think it's like a little bit of like the lipstick effect, that maybe if times are tough, you buy white label food products, you don't spend up for the brand names, but when times are tough, you also spend on nice little luxuries. People go out, they still buy lipstick, they still buy personal care. So maybe this is also a safer economically kind of portfolio that Unilever's left with.
Right. You still need to buy your Tresemme.
Yeah, and if
I don't.
Yeah, no, you don't. I was going to say if you're in GLP-1s, you still need Tresemme, but.
All right, let's take a look at what's going on with futures. Tresemme, by the way, is a shampoo, for those of you who don't know. We're looking at big gains here after the Wall Street Journal reported that President Trump would be willing to just leave Iran without the Strait of Hormuz reopened, I guess without recovering the highly enriched uranium, without regime change, without unconditional surrender. That's just a report from the Wall Street Journal. And it's safe to say that Pete Hegseth made it sound like we're willing to go at it even harder at his press conference at 8 o'clock. But the markets are bidding up stocks on that Journal report. So S&P futures and NASDAQ futures remain up more than 1%.
Coming up on the show, Cameron Dawson from NewEdge Wealth says it's ironic how investors are looking through the war impact on earnings and the economy. We're going to explain more. She will join the show. Coming up next, this is Bloomberg Open Interest. Wall Street analysts appear optimistic as the war in Iran, and that it will end soon after being burned by the taco trade time and time again. NewEdge Wealth's Cameron Dawson says that the irony is that compared to all of those other disruptions, the Iran war likely has the most immediate impact to growth given the jump in energy prices, and yet analysts have been hesitant to cut forecasts this time around. Joining us now is NewEdge Wealth Chief Investment Officer Cameron Dawson. And Cameron, I love this take because so many people have been burned in the past by past crises, saying everything has changed. Should they, though, be downgrading their estimates this time around?
I think the answer is yes, because we can see a more immediate impact to growth than something like tariffs. If we think about tariffs, it was going to take a long time for those to work through the system, to work through supply chains, and yet analysts were really quick to cut their forecasts in 2025. And so we think in this time around, the fact that analysts aren't cutting their forecasts is likely more of a sign of complacency and hope that this will pass quickly, not necessarily being very grounded in reality.
So, I mean, the biggest concerns are hit to growth, obviously, because of the inflation that we're seeing. And we already had a pretty difficult time with inflation. How bad could it be?
Yeah, so I think if we use the proxy of 2022, it's a really good example of how quickly we can see higher energy prices encroach on consumer spending. Back then, we went from 3% to 5% of energy as a percentage of income spending. So what that led to was a pinch on overall consumer spending. The very big difference today is that real wage growth has been much weaker going into this period. You have far less savings to lean back on. At the same time as that the jobs market isn't growing. Remember 2022, you were adding an average of 400,000 jobs a month. So this is a very different world going into an energy price shock. So the big question is, does this energy price shock sustain and linger to the point where it really does start to weigh on consumers' ability to spend on other things?
All right, well, it's concerning that we see WTI up over $100 and holding, gas up over $4 and holding. Cameron Dawson is going to stay with us through the opening bell as we see futures actually rally on a Wall Street Journal report that President Trump is ready to leave Iran. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at what's going on in futures. Big rallies here, more than 1%. Actually, I say that, and I've been away for 3 days, 3 trading days. So this level on the S&P is shocking to my 401k. Let's take a look at what's going on at the opening bell at the New York Stock Exchange. You have Hershey, their stock year to date up about 20%. So doing like the opposite of Microsoft. Maybe chocolate would have been a better investment. They face obviously headwinds of higher cocoa prices. And I would say down at the NASDAQ market site, but actually I should say out in Cupertino, California, you've got Tim Apple ringing the opening bell, and their stock is down 9% year to date. So only doing about half as well as Hershey so far in 2026, which could be this could be the worst start to a year for the stock market since 2001, or depending on what happens today, 1977.
Apple has been doing better than the big hyperscaler spenders, which is always ironic to me that maybe they win the AI war by literally spending no money on it.
Right, they've been doing less bad, I would say.
Exactly, which, you know, is a thing right now. Some of the stocks I'm watching here at the open, Matt, some of the sectors that had been struggling on the onset of the war, they're now climbing on this idea that Trump will wind down the conflict soon, even if it means not reopening the Strait of Hormuz. So a lot of the travel stocks, they hadn't done well. Delta up almost 2%. Gold, which has been insanely volatile, it's up today. Anglogold, that's up 4.4%. And the banks, they've also had a pretty tough run since the outbreak of the war. JPMorgan, along with Citi, along with Morgan Stanley, up 1.33% this morning, Matt.
Less badly, I should say. I don't want to leave that hanging.
Okay, that's good,
you know, in case my mom is watching, I need to clarify that. McCormick is combining with Unilever's food unit in a $45 billion deal that will create a global seasonings, sausage, and condiments giant. And we see actually McCormick falling 10% today, Unilever down 2.33%. Probably Crystal C knew to expect a reverse Morris trust. For me, it was difficult to comb through the PR Newswire release and figure out that McCormick shareholders are only going to have 35% of the combined company, even though they're still going to run it. Their C-suite will still run it, and they're going to keep the name.
Yeah, they're going to run Marmite? That doesn't feel right.
That an American company has Marmite?
Has Marmite? How many Americans do you know eat Marmite?
0. That's the number.
Yes,
Pretty
that's probably right.
All right, NewEdge Wealth Chief Investment Officer Cameron Dawson, whom I'm also sure does not eat Marmite, is sitting with us here at the desk. But, you know, it's interesting to look at stocks like, we were talking about Microsoft earlier, down 25% year to date, while Hershey is up 20% year to date. Where do you hide in times of turmoil? I would have thought that the Mag 7, that these hyperscalers, that Apple would be a safe haven.
Well, they're not as much of a safe haven if they have further room to fall on valuations, which is precisely where we've seen the weakness within tech names. Their valuations have fallen by about a third since the peak in early November, and now they're actually close to their 2022 low in valuation. So you've had a pretty meaningful reset. I think one of the things that the market is contemplating right now is what valuation do we ascribe to names where you're continuing to see really strong earnings growth, but not strong cash flow growth. The free cash flow has been stagnant because they're spending so much money on CapEx, not necessarily Apple, but they're spending so much money on CapEx that the free cash flow generation has really deteriorated. And that likely is one of the reasons why we've seen so much multiple compression over the course of the last 5 months.
But I just want to point out, and I'm sure you saw this too, Dani, on a competing network, Warren Buffett spent the last 4 hours, I think, talking to Becky Quick. He says stock valuations still aren't attractive.
Yeah.
And notably, Apple is their biggest holding. When do we get there? How low do we need to go?
Yeah, so we're now trading at about 19 times forward earnings. That's down from 23 times forward back at that November peak. To put it into context, we bottomed in 2025 at 18 times. We bottomed in 2022 at 15 and a half times. So if you look at the long-term history, 19 times is really not that cheap. It's still above the 80th percentile of historical readings. So if you are in an environment where you continue to see tightening liquidity, which we think we are most certainly in right now, at the same time as we think we should call questions about where EPS estimates are, given the fact that they're baking in growth for 16% this year and for next year. All of that suggests that we should expect more volatility as the market works through both high multiples and high earnings expectations.
So for this overall market then, you have a lot of the big caps still too expensive that maybe have more room to work through. And then on the other end of things, you have energy's impact to things like consumer goods that hasn't maybe fully been factored in. Where is there more room to run in this market right now, Cameron?
Well, we are seeing right now two areas that are doing well, which is energy and very deep defensive. So you think of utilities, we've seen some signs of life out of staples as well as healthcare. The thing to remember with those areas is that they are classic here for a good time, not for a long time, meaning that they experience kind of episodic volatility to the upside when people are concerned about things like growth or inflation. And so what we would see is that if those things start to continue to outperform, that those are moves that you would like to fade and then start to pick up some areas that are more on sale as we see more of the air being taken out of some of these tech multiples.
I want to bring it back to oil, which we kind of started on because we were talking about inflation and you were saying it's the duration that really matters. At what point do you really start to worry about a recession? I mean, if we see $100 crude or $90 WTI, I imagine, is just as painful for 6 to 12 months. That's a problem.
And I think it's the detail of what happens to gasoline and diesel prices. A good reminder, back in 2022, oil prices peaked fairly quickly after Russia invaded Ukraine. However, gasoline prices didn't peak until all the way into June at $5 a gallon. So for us, it's really watching that movement higher in gasoline prices, and that's what's going to pinch the consumer. And if those continue to climb because of things like refining capacity, that's where we think it'll start to weigh on consumer spending in a more meaningful way.
I was talking to a buddy, by the way, in California over the weekend, and he said they're paying more than $7 a gallon. Now, I pointed out that's their own fault, right? Because of
Yes.
the regulations they have in place. And
Yes.
also, I imagine that's premium gasoline prices. But still, it's shocking.
Right. Well, it just goes to show that, like, on the ground, the situation is worse than just the index level of $4 a gallon. But Cameron, I feel like if we can use a corollary to COVID times, so many people expected, again, going back to where we started, that it would be really painful for the equity market. And what you heard from a lot of strategists who expected that and it didn't play out, they're like, it's because of stimulus. It's because the government stepped in that everything was okay. Could that repeat this time again, that you have a government and a Trump that's facing midterms and so stimulates the consumer and again, it's, oh, everything's okay?
I think it's a really interesting question of how high deficits could go, because do we have the fiscal space, given the fact that we went into this energy price shock with already pretty high deficits? We're now questioning whether or not we have to give the tariff money back. So that would push the deficit even higher. If you're talking about doing any kind of offsets or stimulus to consumers, that pushes the deficit even higher. And this is a very different world and potentially different Fed that's willing to step in and potentially buy all those bonds. Because if you remember, going back into COVID, inflation was very low already. So the Fed had a lot more degrees of freedom to step in and be able to provide very aggressive stimulus to help monetize some of that fiscal stimulus that we were seeing from Treasury.
It's true. We're at such a different starting point. Cameron, thank you so much for joining us this morning. That's NewEdge Wealth Chief Investment Officer Cameron Dawson. Let's get a check on your equity markets about 9 minutes into your trading day, and we are higher by 1.9%. We ended lower yesterday. It's been a tough month. As Matt pointed out, the worst start to the year since 2001. Is this what turning it around looks like, with the president reportedly, the Wall Street Journal, saying that he would end this war even if it means leaving the strait closed? It's the Mag 7 that is leading us higher with the overall more positive risk sentiment. Eli Lilly's in the top of the ledger just right here. They're doing a deal, buying a sleep treatments business. On the downside, you have Constellation Energy. They reported earnings. It was not so good. Micron taking a dive again. These chip makers have had a really tough run. I think Micron and SanDisk have lost something like 30% only in the past couple weeks. P&G, so a lot of these staple names are down. Biogen, I think they're also doing a deal. McCormick doing a deal with Unilever. So both deal names in both gainers and losers. Now, for the individual indexes, everything is gaining except for utilities. So it's a flee from safety, maybe some more of the risky kind of names, consumer discretionary, communication services, infotech, all of those stand at the top of the pile, Matt.
So many deals today.
So many deals.
Do you think about sometimes like just doing your deal show randomly on a Tuesday?
Yeah, but don't you think that confused people? They'd be like, it's Tuesday, and
But
there's
maybe
a deal
twice
show?
a week, because there's so much.
That's true.
To talk about. We're going to continue talking about deals when we come back. Eli Lilly making its biggest acquisition in years as it looks beyond the booming weight loss business. Sam Fazeli, our head of healthcare research and BI in general out of Europe, comes up next. This is Open Interest.
We are at the highs of the morning, up 1 1/3% for the S&P. NASDAQ outperforms even more as the Mag 7, but Brent crude crucially still holding on to $107 a barrel. Cameron Dawson just telling us perhaps we haven't written down our expectations for earnings and for growth quite enough given what's happening in energy markets. Some of the top calls, the analyst action that we're watching this morning. First up, TD Cowen, they downgrade Colgate-Palmolive to a hold. They cite resin cost headwinds from the Iran war, so add that to another supply chain that's being disrupted. Next up, Citi, they cut their price target on Micron to $425. They point to the recent pullback in memory prices. Micron has been getting destroyed over the past couple days. That continues down 2.4% this morning. Finally, Needham downgrading Contessa to hold. They cite Eli Lilly's agreement to buy the sleep drug maker in a deal that's worth $7.8 billion. Matt, those shares up 45.5%.
Wow. Okay, that's a big jump there. Let's talk about a couple of big deals that I'm sure you will also discuss tomorrow on your deals program, Dani. Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli joins us on some really fascinating stuff. Sam, you know, Lilly has, even though Novo kind of created the category, dominated the weight loss sector, and now it's moving on with a $7 billion investment to sleep disorders. Are they just trying to diversify here, getting ahead of patent cliffs later on?
Well, Matt, when you look at the relative numbers, $7 billion is a drop in the ocean for Eli Lilly. And if you think about the drug class they've just bought, which is an area they've not been active in before, which is sleep disorders. If you look at consensus for Contessa, the revenues are around, say, 2034 or 2033 at around $2 billion. Guess what Lilly's numbers are? 150. So it will be, this is just Lilly padding its nest, if you like, for want of a better phrase, and creating more businesses that fit into certain parts of its activities. This fits into its neuroscience activity, although it's not an obvious area for them to have gone into. So it's helpful, but these are drops in the ocean.
Can I just ask, Sam, on the actual research into sleep? I mean, what they did with weight loss was like game-changing. You just flip a switch, and all of a sudden, you lose a significant amount of weight. Is that possible in sleep? Could I just take a pill and have like 7 hours of solid REM and deep sleep and wake up feeling totally refreshed?
Matt, I think you read my mind when we talk about these things. The point about the drug class that they've just bought is exactly that. It is supposed to be much better for preserving what's called your sleep structure, which you just referred to. REM sleep, deep sleep. Now, a lot of existing sleeping pills kind of mess that up a little bit, whereas you get a lot of one and not the other, and therefore you kind of have to do catch-up when you stop taking them. Here, with this class of drugs, the orexin targeting drugs, you don't have that. But they're not going to be the first in class. There's already a drug on the market that targets this process and this mechanism, and it does exactly that.
Sam, and Matt mentioned this, the patent cliff coming. For all of these drug deals, are they paying a fair price, or are they incredibly competitive? Because most of these drug companies are dealing with the same issue this year.
Yeah, I mean, we've done quite a lot of work on these patents. You should be careful what it says on the tin in this particular case, because a lot of these patents can be protected later beyond what the current company details suggest. And so as we have a very strong patent team that looks at these things. So, of course, patents eventually expire. There's no way of keeping them evergreen, although companies try. But I think in this particular case, Lilly is safe for at least a decade when it comes to this. So I wouldn't be too worried about Lilly. Other companies, such as Merck, such as Pfizer, such as Bristol Myers, they do all have to deal with it at different times. And they do these deals to try and help cushion that cliff.
I have a viewer writing in, trader, friend of mine, Sam, writing in and asking about sleep apnea, and he is a physically fit specimen. So it's interesting because he suffers from this. It's not about, I guess, all the time being overweight or what you eat. It's about actual muscular control while you're sleeping.
Absolutely.
How have pharmaceuticals been dealing with this issue? Because I know obviously you've got the CPAP machine and stuff, but who wants to have this device on his face when he's sleeping?
Yeah, so again, Matt, perfect question with regards to the conversation we're having. The acquisition brings Lilly an agent that helps you maintain or increase your ability to sleep and stay asleep. But remember that the GLP-1s have already been proven as a good mechanism to try and manage and reduce sleep apnea. So that's already in their label, and I think they're already used for that. So, but it's not just because of the weight loss, but of course it's related to that. But folks who have sleep apnea, despite being very light, I think they may not have as much benefit from GLP-1s as somebody who is suffering from sleep apnea because of obesity.
Hey, Sam, thank you very much for joining us. You're one of the best. Sam Fazeli from Bloomberg Intelligence. Coming up, Nike earnings ahead. China remains the key question as investors look for signs of a turnaround. That's coming up next right here on Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. A quick check on stocks, which are rallying pretty significantly. S&P 500 up 1.5%. I have to point out that we're still well under 6,500 So it's been a horrible month, a horrible quarter for stocks, but it looks like a pretty good session so far. The NASDAQ doing even better, up 1.6%, but still at 23,324. That's weak sauce. Take a look at Brent crude here, still $107, and actually NYMEX is well over $100 as well. So we've been watching Brent lately because it's a more alarming figure, a much higher number, but that spread has tightened up a lot. And NYMEX, even though you hear everybody say, oh, we're not dependent on Brent crude, we're looking at our own West Texas Intermediate up over $100. NVIDIA is up over 2%. This is behind a lot of the big gains you see on the indexes where it's listed and worth 7-8% of those indexes. It's a huge company. SanDisk actually gaining right now, up 3.7%. And you saw Micron and some others falling. Fannie and Freddie up bigly, 6% for Fannie, 8%, 9% for Freddie on Bill Ackman touting that stock. Unilever is down right now, 4% after the big deal that it did. A lot of consumer deals today. And then, of course, Nike. We're going to talk about the earnings right now, how well it's doing in China, the pivot away from direct to consumer. But right now it's up 2%, almost 2%. So it looks like, Dani, investors are optimistic.
Let's talk about that right now because Nike reporting earnings after the bell. As you mentioned, Matt, China is a key area to watch. CEO Elliott Hill spoke with Bloomberg's Romain Bostic in February.
As you think about China, we have to lead with sport and innovation. And that is the focus as we move forward. You'll see us reposition the brand through the lens of sport. And it's not just through product, but it's through the athletes and the stories we tell, much more local.
Joining us now is Bloomberg's retail reporter, Lilly Meyer. Lilly, I want to talk about one aspect of Nike that you've been reporting on is how poorly Converse has been doing. And the fact that, they might have a suitor? Do they want to sell this thing? What's the latest?
Yeah, so I think everything that they've said publicly indicates that they're not interested in selling Converse right now. They're committed to the brand, but we reported today that Authentic Brands has expressed interest in Converse if it, is ever up for sale.
I saw some Converse All-Stars on the plane.
Yeah.
That were the traditional All-Stars, but then they had this 1990s rave platform shoe bottom.
That's kind of cool.
No, it wasn't cool at all.
No, you don't like that?
It was horrible.
I'm really into funky shoes, but maybe not funky Converses.
I don't know, this platform shoe thing.
Yeah, I got to get height where I can.
No,
you wouldn't understand that.
I'm not about that. Let's talk about Nike and the direct-to-consumer. I thought it was interesting that they spent so many years going so hard DTC, right? And you could customize your own shoes, and it doesn't matter if you go to Foot Locker or whatever other place used to sell shoes. Now they're pivoting back to those chains.
Yeah. So I think under Elliott Hill, he's tried to kind of utilize all of their channels. So, focusing on DTC, trying to rebuild some of those relationships that, struggled on the wholesale side as well. So I think he's trying to kind of get both avenues going.
Retailers don't like that when you say, we don't need you, we're going to go direct to consumer. That doesn't work well.
Yeah. Yeah, and he's been successful at rebuilding some of the relationships.
I think about all the time, I think it was 2 years ago, I was at a Dick's Sporting Goods and I wanted to buy new sneakers. And I was talking to a sales associate and they were like, oh, the innovation at New Balance is so interesting. Look at the running shoes from this and that. I mean, that's evidence that Nike clearly either hasn't done the innovation or didn't do enough marketing pushes with some of these retail outlets. What about the innovation side? Have they been catching up with things like running shoes where On and Hoka have really come in?
Yeah, that's a great question. So they've made a lot of progress on the running side and kind of regaining that core consumer that's obsessed with running. And they've also promoted innovation recently. So for the Olympics, they had a new slate of products that came out. They had the Nike Mind, which are these slides that have bumps at the bottom that kind of stimulate mental activity. So they're kind of trying to expand their innovation side.
Slides with bumps on the bottom.
Yeah, I'm doing a poor job at explaining that.
When you say slides, you're talking about the slip-on, the shower shoes.
Yeah, they're kind of like recovery shoes
that people now wear casually, like even to work.
Oh, yeah, no, that's straight to jail. No toes should be out in the workplace.
I don't believe that should be allowed either. Lilly, thank you very much. Lilly Meyer there covers Nike, and of course, Romain Bostic is all over this company. You'll see the earnings coming out on his program that close, and that's the perfect place for them to be. Coming up the next hour, Meredith Whitney on the health of the U.S. economy, plus Apollo's Akila Grewal talks about private credit, and the CEO of Citizens Financial Group joins the show on regional banking. This is Open Interest. We are 30 minutes into the trading day and rallying hard. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Burger. We are up more than 1% on track for the best day since February 6th.
And I'm guessing there's some economic data crossing the terminal because Mike McKee is sitting right next to me here. I've got my eco screen open on the Bloomberg terminal, and I see that we're due to get JOLTS as well as consumer confidence numbers.
And we did. So that's all I got for you. No. JOLTS level everybody's interested in because it's a February number. We're finally caught up now. It's still a month before, but it does show that job openings were a little lower, 6,822,000, down from 6,946. The quits level is at quits rate 1.9%, the layoffs rate at 1.1%. The quits rate down a tick, the layoffs rate up a tick. And then consumer confidence is surprisingly stronger, 91.8 up from revised 91.0. Present situation 123.3 from 120. And expectations, that's the only one that drops, 70.9 from 72. So it is a bit of a surprise because we saw the Michigan numbers go down, and these are March numbers for the Conference Board. I'll check on and see what we get from them in terms of the breakdown of their numbers in just a second. But I can also tell you that job openings went up because I just got the revised number for January, 7,240,000. So we went from 7,240,000 down to 6,822. So it is a bigger drop than we thought, and it does shows the labor market is remaining quite loose.
It doesn't look good, Mike. So we've basically more layoffs, right? Companies are firing more people. Workers are quitting less, so they're less confident to leave their jobs and look for something else. And job openings are down pretty drastically from 7.2 million to 6.8 million.
Yeah, basically what it's telling you is that we're still status quo in this low fire, low hire economy where people don't know if they're going to be able to get jobs, so they're not going to quit, and where basically companies don't know if they need people, so they're going to keep them there. I just got the breakdown from the from the Conference Board on consumer numbers, and I can give you the numbers on jobs and what people are thinking about it in terms of employment. People think the number of jobs plentiful goes up. It's 27.3 from 26.7. Jobs hard to get goes up a little bit, 21.5 from 21. So people feeling better about their situation at the moment. But we do see a drop in 6 months from now, 15.4 from 16%. Think there will be more jobs, and the number of people who think there will be fewer, 27.9 from 26.2. So people are thinking longer term, this is not good. But in the short run, they remain relatively confident, which is not what you see in the Michigan number.
No, that consumer confidence number coming in just under 92 is certainly surprising. Mike, thank you very much. Bloomberg's Michael McKee. Joining us now is Meredith Whitney, CEO of Meredith Whitney Advisory Group. Meredith, in this moment of a consumer that hadn't been weak, maybe there were some slowings, there are certainly some cracks that higher energy prices might be able to kind of work their way in and deteriorate things. How sensitive do you think this economy is if we continue to see energy prices elevated to where they are right now, especially if one of the president's goals at the moment is not reopening the Strait of Hormuz?
A little less sensitive than you would presume. So a number that Mike looks at weekly data on revolving consumer credit, which is credit cards. This is as of last week. It's decelerating. So normally, if the consumer were stressed, they'd lean hard on their credit card. They're not doing that. The credit card loans are growing at a slower pace than inflation. So what does that tell you? And at the same time, the unused credit card lines are close to $5 trillion, the highest they've ever been. So the available people have massive amounts of liquidity to lean on, but they're not doing it. The one thing that they are doing is tapping into the equity in their homes, and that's the fastest growing loan category. But in past cycles, you would see credit card debt going up, revolving credit card debt going up. You're seeing the opposite.
By the way, Meredith, when I talk to Bruce Richards at Marathon, he dismisses the K-shaped economy theme and says it's really an E-shaped economy, and that we actually do have a big, strong middle class. Do you see it the same way?
I think the Macy's CEO said the same thing, so he's not alone. It's hard to see. So consumer spending's held up much stronger. I think that the bottom, I still think it's a K, because I think more consumers are strained. But one thing that you're seeing and that has risen dramatically is something called earned wage access, where consumers aren't just, workers aren't just living paycheck to paycheck, they're paying a fee to access their pay in advance of 2 weeks. And that keeps climbing. So that tells you that more and more consumers are stretched. I think that, so if there's an E, I would say if there's the top 20, it's the second 20. That may be the E.
Right. Because the top 40% still have a ton of credit, available credit.
That's true. But I'm dividing the 40 into 20. But then the 60 is, you can see it from the data, the BLS. It's living paycheck to paycheck.
So if that top 40 chunk is less susceptible to higher energy prices, how susceptible is it to the equity market? How important is it that we get equities that can stay afloat, or if we enter any sort of meaningful correction or bear market, might that have an impact on what has been powering the economy?
That's such a smart question. I think this is where we get into the real sensitivity, which is the wealth effect. So if people really feel compromised, that their portfolio's down, and statements will start to come out in the next few weeks, that they may start pulling back. But you haven't seen it. You haven't seen it yet. There's a lot of liquidity. That's just going to be a sentiment issue. And you look, this is also, most clients that I talk to, the biggest fear they have is getting caught up in a short squeeze. So they've taken their shorts off and they've reduced their portfolio. They're just under levered. So if the stock market moves, are they going to miss out? And like Liberation Day, if you missed out on the Liberation upswing, you missed out on most of the upswing for the year.
That's what we had talked about in the start of this war, when all of a sudden software was rallying hard. Like, is that just shorts being closed out because people are fearful of that and just getting low to the ground?
Looks like that was the case.
That was the case, yeah.
Meredith, it's interesting if you look at the energy shock that we're facing now compared to the 70s. Now, less of the economy is reliant on oil than then. But those parts of the economy that are reliant on oil don't have any alternatives. Like, they're very reliant on oil. Right. So how do you see $100 NYMEX affecting growth?
Well, one of the categories that has been surprisingly strong is retail. Obviously, it impacts retail. I still think consumer spending is the lifeblood of the U.S. economy. There's stimulus for companies. Growth may be higher. Well, estimates have not come down dramatically, and they may prove out to be okay. The big concern is rest of world and what we've done to rest of world, and how we've alienated rest of world, and how we've alienated emerging markets are the big risk here.
Right. I mean, if you punch a hornet's nest and leave 440 kilograms of highly enriched uranium there, that's not a great hornet's nest to have. But in terms of the U.S. economy, so much of the wealth that you see in the data is in our homes, and we're not selling those or buying new ones. The mobility's stuck.
Yes, that's exactly right. So the home ownership rate for what has historically been the key group of first-time home buyers, 35 to 44, has declined dramatically. And that could be because of affordability, but that's over a 40-year period, or because the American dream has changed and they want experiences, right? But I still think that's a little bit old. It's more of avocado toast that really want the experience. They're not slowing down. So importantly, let's look at the midterm elections. One thing that was a concern for me with the avocado toast is the garnishment of wages for student debt. The administration has pulled that. So they're going to start garnishing wages, if they do, after the election. Now, the Treasury controls the student debt that used to be at the Department of Education. I think it's probably winding down the Department of Education. But that's given the avocado toast a little bit more breathing room. So there are a couple of areas where there's a little bit more breathing room. Any type of stimulus checks will be absorbed by the inflation. So you're not going to see a big, I don't think you're going to see any upside, but you just may not see downside.
Is it your assumption that we will start to get more stimulus, not what's already been announced, but just more if we do have to deal with higher gas prices, that this is an administration that's going to try to feed more into this economy?
I don't know that the administration necessarily cares about the midterm elections. It doesn't shown that it really does, but it should. That could be just because I don't know enough about the inner workings of the administration, but it's playing it very close to, if energy prices are still high, it may not be really hurt the pocketbook or the economy. It hurts the pocketbook of plenty of people, but psychologically, it makes people really angry. And that also is going to, every piece of transport. I mean, my husband from Texas only eats steak. The price of beef keeps rising, right? And more people are eating beef. Everything, prices keep rising. So if Bruce Richards or what the CEO of Macy's said about the middle E, they're really annoyed by the persistency of higher inflation.
And there's nothing the Fed can do about it, right? If we look at these JOLTS numbers, if we look at this jobs market, it's not like the Fed is going to hike rates into this.
And Powell said he's very comfortable with where rates are, basically endorsing let's do absolutely nothing.
It's going to be very hard to cut rates. So I don't know that is going to make any difference, but psychologically, rates are higher. Oil, gasoline prices are higher, and then food inflation is higher.
By the way, I ask only because I think of you as a Washington insider. What's going to happen with the Fed if Jeanine Pirro doesn't drop it with the investigation into Powell? I mean, are we ever going to get a new Fed chair? Because it doesn't look like the Senate's going to be open to confirmation.
I mean, eventually, it's got to be driving everyone nuts. I'm sure it's driving Kevin Warsh nuts, but they'll push it through. I mean, Jeanine Pirro, if Trump tells her to back off, she'll back off.
Right.
All right, Meredith, thank you so much for joining us. Always a pleasure to have you.
With you guys.
Meredith Whitney of Meredith Whitney Advisory Group. A quick check on your markets about 40 minutes into your trading day. Yields still come in. We're down by about 3 basis points, undoing some of the rise we had seen over the past couple of weeks. We're at 431.66. And a rally on our hands. The S&P and NASDAQ up 1.5%. If we're able to close at these levels, it would be the biggest rally in about 1.5 months. Brent crude, it does fall only 0.5%. We are sticking around $106 a barrel. Coming up, Akila Grewal of Apollo Global Management as the private credit industry faces redemptions, some negative returns in February. That's coming up just on the other side of this break right here on Bloomberg Open Interest.
Private credit is something as you guys are probably following. It's a relatively small part of a very large asset pool. We're watching it super carefully, as everyone is. We're talking to the people in the industry and investors and everything. I think we understand it. We're monitoring it. For looking for things that might lead to greater contagion or greater losses or connections to the banking system.
That was Fed Chair Jerome Powell speaking at Harvard University. His comments come as the ECB and Australia's corporate regulator boost supervision of the private credit industry. Let's get more on the asset class with Akila Grewal, partner and global head of the institutional client group at Apollo Global Management. Akila, great to see you. Thanks for joining.
Of course, happy to be here.
We can talk about those regulatory fears in just a moment, but I would love to hear from you because you oversee the institutions. You're constantly talking with sovereign wealth funds, with pensions. What are you hearing from them right now? What kind of questions are they asking you? Do they want to allocate more? Are they nervous? What's the sense you're getting?
It's a great question, and I think, talking around the globe, you get a little bit of a different answer. That being said, I think that investors are generally cautiously optimistic. I think if you have the dry powder, if you've been patient in terms of your deployment, this actually could turn out to be an amazing vintage because you are going to see more dispersion. You are going to see more dislocations. So if you have the ability to capitalize on that, investors are looking for how to do that and what's the best place to do that.
I get why, because people are going to tighten credit standards and rates are more attractive than they were in previous vintages. But is there no knock-on effect from the problems in the older funds? I mean, the maturity wall coming due, the refinancing risk, does that not hurt these companies raising new funds?
I think it will to some extent. So I think a big part, like the eye of the storm and what we're talking about in private credit is AI and software. But if you take a big step back, the private credit universe, the way that we think about it, is a $40 trillion addressable universe, of which $2 trillion is sub-investment grade, of which $400 billion is BDCs, of which 30% is software. So you're talking about a relatively small piece of a bigger puzzle. Doesn't mean that there's not going to be defaults or there's not going to be stress in the system. And I think people are going to look through to what type of software exposure, what type of AI exposure that I unwillingly have taken, and what's that going to look like in my portfolio, but also understanding they still have deployment needs and what's that going to look like in the future.
Are your institutional clients also asking about your retail exposure? Because we've had people come on, and I'm going to be 100% honest, they tend to be people who don't have retail exposure. And they're like, oh, our LPs love us because we don't have retail exposure. And they're moving more to the types of funds that are just concentrating on them. Do you ever get that kind of pushback from your institutional clients?
I would say we have been very specific in the type of strategies that we've brought to the broader wealth ecosystem. And I think private credit and BDCs are actually the structure of a BDC is actually quite prudent if you think about it. It's allowing investors to get access to private assets in a structure that can give you liquidity up to a limit. And so I think by the way that the BDC is ultimately structured, that asset in that structure actually makes a lot of sense for wealth investors.
Your colleague Jim Zelter was speaking at the Asia Pacific Financial and Innovation Symposium. I thought he said something interesting. Certain distribution channels in parts of the globe may have not fully communicated the risks inherent to the asset class. Do you think that's kind of what's going on in this moment? That maybe some of these wealth advisors didn't fully tell some of their clients that, yes, there's some liquidity, to your point, but not as liquid as public asset classes?
I think that there's always a education that needs to be happened when you think about including private assets in structures that do offer liquidity. And so there might be some of that, but equally, I think the way that you respond is just as important. And I think from our perspective, given the portfolio that we have, given the low leverage, the high quality, it's first lien, our ability to meet the redemption standards while also still having the appropriate amount of dry powder to deploy should this vintage, as we're talking about, be really interesting, is actually going to work out really well.
You are seeing a ton of money still going into private credit. I mean, regardless of all the headlines that all the cockroaches we've been talking about, right? And as you mentioned, right, that's only a small subset of a small subset of loans, but is there a point at which so much capital coming in compresses risks, further compressing returns?
I think that what we've seen, if you take a step back and you look at the last few years, right, there has been a lot of capital that has been formed and a lot of capital that entered the market, driving very competitive terms, to your point. I think if there ends up being a little bit less supply, so to speak, because of the BDCs or other areas where there might be a pullback, that's actually going to allow us to have better credit standards and be much more thoughtful in terms of the exposure that we do take.
But it seems like better credit standards, plus you're moving into more investment grade debt, like smaller returns. Less risk, but smaller returns. Is that?
I think that our view is that it depends on where you are in the risk curve. Certainly, investment grade is going to yield lower than high yield or high yield equivalent risk on average. That being said, our view is that private assets actually have a place across the entire portfolio versus just a small alt sub-investment grade portion.
So you've also been describing the ability, this is a good vintage. If you're able to deploy, you'll do really well. And that feels like getting into this idea of manager dispersion, of the haves and have-nots. How extreme does that get? Are we about to witness, or are we already witnessing something of a shakeup in this industry?
I think you're going to see more dispersion in the markets, but also more manager dispersion, to your point. Apollo has about $125 billion of dry powder, give or take. That's going to set us up quite well. I think if you're a manager who's been fully deployed in older vintage risk, that's going to maybe potentially limit the ability that you can deploy in today's vintage, which we do expect over the next 6, 12, 18 months to be very attractive.
The thing I always struggle with that, though, because it's not like something that just like disappears overnight. It's kind of this small, like maybe you have to wind down your fund, babysit the portfolio that you currently have. You can't raise more. So what does that environment actually look like if you have less players who are deploying capital? Is it like, do valuations come down because there's less competition? Does it mean that the Apollos of the world get bigger because there are interesting other asset managers you can buy up? What's the practical implication of that dispersion?
I think the practical implication is that some of the managers that do have the dry powder or have been cycle tested will likely grow and likely gain more market share. I don't necessarily see that it'll impact valuations of the underlying asset because hopefully you'll still be disciplined in your approach. But I think you'll see those managers grow. And then I'm sure there'll be more options for investors when you think about the secondaries market. People looking to take risk off the table in their older vintages, and that will continue to build a secondaries market. So there'll be other options for liquidity that investors will have available to them.
All right, Akila, we're going to have to end it there. Thank you so much for stopping by. Always a pleasure to see you, Akila Grewal of Apollo Global Management. Still ahead, we're going to get more on private markets, but on the equity side of things. The CEO of HGGC, the private equity firm co-founded by Hall of Fame quarterback Steve Young, Rich Lawson, is going to join this show later in the hour. You are watching Bloomberg Open Interest.
All right, welcome back to Open Interest. Got to check on the stock market right now amidst a serious rally. You can see we're up 100 points on the S&P 500. Still brings us only to 64.43, which is kind of depressing if you happen to check your 401k. Up right now, 382, down 118. So the breadth is strong to the upside, and you've got NVIDIA adding more than 3%. So NVIDIA alone is good for 16 points here. Microsoft, which is down month to date, by the way, Microsoft is down, or year to date, I should say, 25%. They're gaining back 2% today, adding 6 points. Amazon, Alphabet, Meta. So you see Apple here, Tesla, all of the Mag 7 stocks. On the downside, Constellation Energy taking a hit after earnings that disappointed, down 7%. By the way, let's take a look at the sectors month to date. Just real quick, energy is doing the best. This is month to date, remember. So up 13%, the energy sector. Everything else is down, including these halo assets and industrial. Coming up, Citizens CEO Bruce Van Saun joins us on how regional banks are navigating this volatility. It's a tricky moment for regional banks, slower deal making, questions around private credit, a more cautious client backdrop, at least according to Michigan. With earnings just around the corner, investors are watching closely for signs of stress and shifts in client behavior. Joining us to help navigate these times is Bruce Van Saun, Chairman and CEO of Citizens Financial Group. Bruce, always great to get your read on the economy and the sector. Let me first start with the credit issues. I mean, how do you see consumer credit right now? Meredith Whitney was just telling us that we have a lot of open lines here. We have access to a ton of liquidity. How does it look?
Yeah, I'd say our credit books look very good at the moment. So we are in a bit of a two-tiered economy for the consumer. People well off are really not affected by what's happening in the macro environment. And I'd say people less well off, obviously, have fallen behind with inflation, and wages haven't kept quite up with that. But more of our orientation is towards super prime and high prime borrowers. So all our metrics are pretty solid on the consumer side. Same thing with C&I portfolios. Most companies had a good year last year, are planning to do well again this year. There's clearly an increase in uncertainty given the war going on and potential impacts on energy prices, but I think still poised and feeling good about things. And CRE as an issue has kind of moderated and is being worked out. So we feel generally good about the credit position.
On the point of corporate clients, I mean, it's been a year or I guess, a past 12 months that's been bookmarked by some of these kind of credit blow-ups having to do with fraud, what have you. JPMorgan talking about cockroaches. Have you changed your underwriting standards at all, or have you changed how you do due diligence because there is this fear of maybe there are more risks out there when it comes to credit?
Well, I'd say we haven't been affected. We haven't had any cockroaches come out into our kitchen, but I think we always were quite disciplined, and some of the newer players, some of the private credit players maybe didn't have the same level of rigor and discipline, and so they're getting called out on some of that, but we haven't changed a whole lot. We're monitoring private credit and our exposures there quite carefully, but we just did a full review of that and feel from the bank standpoint, we're in really good shape based on the structures and how much underlying collateral and diversification we have. And I'd say, private credit is having a moment, and I think the growth will slow down as they work through some of that. But I think the kind of issues they have been a bit over-dramatized.
Did you do that review just because of the noise out there?
Yeah, I mean, when we just had a board meeting in March, and so you want to make sure, okay, what is Citizens' exposure to private credit, to BDCs, is fairly limited, but in any case, structurally, we're in a very good place, so we don't see big risks for us. I think one of the risks is if these private credit firms need to keep going to market and selling bonds and getting liquidity, does that dampen overall asset prices to some extent? And what's the second order consequence of that? So we're keeping our eye on that. But direct credit exposure, feel good about that.
And, in private credit, we talk about a maturities wall, but everybody has to refinance, right? And rates are right now the 10-year at 434, 433. Looking pretty punchy. How do you feel about refinancing?
I'm not that worried about it. I mean, ultimately, we came into the year, our call was by the end of the year, the 10-year should be between 4.25 and 4.50. So that's still, by historical standards, reasonable long-term rates. And you have to remember, too, banks, if there's steepness to the yield curve, we make more money off of that. So feeling pretty positive about where things are right now.
Some of the rate environment changes, the volatility because of the geopolitics of the moment. We've had plenty of people, M&A types, come on the show and just say the volatility is causing a bit of a slowdown. What are you seeing on your end? How has the deal-making environment fared?
It's been like coming into the year, we had huge backlogs across everything, across syndicated loans, debt financing, equity financing, M&A. And, good news is that the war didn't start until we had 2 months in the bank. So, like, when you look at first quarter, things are still solid. As spreads have widened a little bit, I think issuers may hold back and think about the timing, like wait for a little better moment, maybe when the war resolves itself. Same thing with equities. You're not seeing as much IPO activity, but there's still people ready to go, poised to go. And I'd say M&A really hasn't slowed down. So we're still printing a lot of M&A transactions.
Before the war, we were pretty focused on what AI could do. It seems to be kind of eating the physical economy. And of course, software was an issue. And you're rolling out, you have a strategy, Reimagine the Bank, right?
Yeah.
How do you see AI taking jobs or allowing you to reduce costs?
Yeah, I think it's a force for good. So I think it's very exciting, and we certainly have to tap into that and get the benefits of that. Our Reimagine the Bank program, we stepped back and we looked at everything a bank does. How do we onboard a customer? How do we deal with a complaint or a fraud on someone's card? And then let's picture it how it works today, and then start with a white canvas using all these new AI tools and agentic bots. Like, how could we redesign that to be so much better customer experience and then more efficient at the end of the day? And so we basically put that together into a program which has about 50 initiatives we think will benefit to the tune of about $450 million within 3 years. About 2/3 of that is on expenses. 1/3 of that is better customer retention, given the better customer experience. And so I think we've had a track record of being able to convert the ideas and the promise into something that's tangible. And so I feel good about how this thing has launched and that we're going to go get it.
But you can use AI more, and then you have to pay fewer people. Is that the idea?
Well, what's interesting is, if I go back to when I took over at Citizens 12 years ago, we had about 18,000 people. I fast forward today, we have about 18,000 people. We've done acquisitions and investments in different areas of the bank for probably 4,000 or 5,000 people, and we've thinned 4,000 or 5,000 people from operational intensive activities, from having more branches than we needed. So if you look at it, we've self-funded these investments in kind of higher value-added jobs and more customer-facing jobs. And so what I think you look forward, you may see fewer people, but you also see growth in other areas that should generate more revenues and keep the bank growing.
Do you subscribe to this idea that like what we're seeing down the road is going to lead to just this huge revolution, that the way we think about entry-level jobs are going to change? Yes, it might add jobs, but that's going to change. The friction in the banking system is going to change. Like, are we on the precipice of some really major Citrini-like differences in this global economy, or is it just additive and efficiency producing?
Yeah, I don't know. I think there's probably over-anxiety about how this is going to work out. If you look historically, every time there's been these great new innovations, like when we first had a spreadsheet, like, oh, we don't need financial analysts anymore. Well, guess what? Financial analysts got to do more value-added work. And so I think if you're a well-rounded person, you come out of college, you have good communication skills, you have good EQ to go with your IQ, you understand how the world works, how businesses make money, there'll be a role for you in the company. It'll be different maybe than some of the entry-level jobs of yesteryear, but we'll still need to keep replenishing our colleague base.
All right, Bruce, great having you on. Love to get your take. Bruce Fenzon there is chairman and CEO of Citizens Financial Group. Let's get a check of what's going on in the markets right now. Seeing a big rally here, 1.5%, almost 100 points added to the S&P 500 at 6436. The NASDAQ up 1.7% at 23,338. We're coming back up to still relatively low levels here, Dani, and the 10-year yield at 432 is kind of holding, as is NYMEX crude. This is NYMEX, by the way, not Brent, $103.07 a barrel. So you're seeing that spread tighten up.
That's been really one of the interesting features over the past couple of days, and yet we're rallying. Some of the single name stocks that we're also looking at this morning, NVIDIA investing $2 billion in Marvell as part of a strategic partnership to connect Marvell to the NVIDIA AI factory. Those shares up 8.25%.
By the way, NVIDIA also helping a property developer, Tract, to sell $3.8 billion of junk debt. So I'm going to talk about that on the Tech Show. I'm going to anchor that next. CoreWeave, we'll talk about as well. You better believe it. CoreWeave has raised $8.5 billion from a group of banks and investors to help finance an expansion of its cloud computing capacity. So the neoclouds are up today.
And Unilever combining its food business with McCormick in a nearly $45 billion deal. It will create a condiments and spices giant, so spices alongside Hellmann's mayo. Stocks are down, though. All these, both McCormick and Unilever, down at least 4%.
Yeah, that's a very complicated reverse Morris trust that they've
The good old reverse
there.
Morris trust.
Coming up, we're going to speak with Rich Lawson, who co-founded private equity firm HGGC alongside a Hall of Fame quarterback you may remember, Steve Young. We'll get his take on the private credit market and his business. This is Bloomberg Open Interest.
The private equity firm co-founded by Hall of Fame quarterback Steve Young, HGGC, collected $3.2 billion for its fifth fund earlier this year, blowing past its target in a very tough fundraising environment. Let's get more with Rich Lawson, HGGC co-founder and CEO. Rich, thanks so much for joining.
Thanks, Dani.
And by the way, you had an excellent conversation with Jason Kelly when you closed this fund, but a lot has happened since then. I would love to hear from you because I know a really big and for a very long time part of your LP base, your investor base, has been Middle Eastern sovereign wealth funds. They're facing a lot of volatility there. What are you hearing for them in their plans, deploying capital? Does it change when they all of a sudden enter wartime footing?
I think for what we do in sort of U.S. mid-cap middle market private equity, nothing has changed. I think for us, was probably in the Middle East 7 times for the last year or two. That's changed in terms of the opportunity to travel back and forth. But I think the interest level in the asset class, the alternatives in middle market, is still very high out there.
But hasn't it slowed? I imagine this last month of war has slowed deal making there. Are deals still getting done?
Deals are still getting done. I think that as people begin to think about the implications, I think you mentioned earlier, Matt, $7 gas. I came from California here, and we all, I think, feel these profound implications of this geopolitical strife. But again, there are certain pockets of the alternatives, and particularly medium-sized companies globally, that are being transacted. We've actually bought a business in Canada. We've taken a business private in the UK. And we've also done a fund admin in Luxembourg in recent times. So deals are still happening.
One of the things I find so interesting about HGGC is and we've talked about this before, you've made the strategic decision to stay middle market, to stay at the size you are, where a lot of your peers who grew up at the same time as you have exploded, have decided to become these huge platforms. Why make that decision? Why not go and become one of these cash-grabbing, publicly listed funds?
Well, for 5 funds now, nearly 2 decades, we have raised 30 to 40% more than our prior funds. And so for us, the opportunity to take and create good businesses and transform them into great companies continues to grow. The denominator of global businesses in Western Europe and North America is only growing in the medium-sized format. And that's where you can generate real alpha. Someone once told me that it's far easier to buy a business for 500 million or 1 billion and sell it for 3 than buy it for 3 and sell it for 12. And we continue to see that cycle in and cycle out through this environment.
Are middle market businesses also more resilient in times of stress? I mean, I think about the tariffs, right? And the big companies aren't agile, and the small companies were in trouble. Mm-hmm. Do the middle-sized companies do better, and do they do better in times of stress like we're looking at now in Iran?
Well, there's a lot of opportunity to help a medium-sized company, thousands of employees, 50 to 100 million of EBITDA, improve. And I think that's where we spent a lot of time helping their go-to-market motion, helping them grow globally. There's just a real opportunity to build a much better business. So it's a very different set. And I also find just fascinating listening to the private credit dialogue that's going on right now. The market's wide open, syndicated market, private credit market for $1 billion transactions and below. We did our first one 17 years ago. And that market, maybe you can't do deals at SOFR 450, but you can get them done.
Well, the other thing about existing in the mid-market, we saw this explosion of funds that existed in it because maybe the barrier to entry is not as difficult for those, $3 billion to $12 billion deals.
Right.
What does your peer group look like now? Because for a long time, people have been talking about a shakeup happening. Has the shakeup come? Are we in the middle of it? How much longer does it last?
There was a period of time where coming out of COVID, folks thought, okay, I can't sell now, but this huge dry powder wall was continuing to grow and liquidity was necessary. I think many times in our industry, people confuse performance and liquidity. It actually requires both. And so to be honest with you, I think that if you're not being able to demonstrate the ability to exit businesses, that is going to be a problem. I think our success in being able to raise a fund that increased the hard cap in this very difficult environment was because we sold and basically nearly half of our unrealized NAV. And because of that, I think that is going to be where the have and have-nots will begin to happen, is folks that were investing that haven't been able to actually return capital.
You talk about you can still get deals done, maybe not at 450 SOFR. What do deals look like now, or what does the financing look like now that private credit has come under stress? And it has been the engine, really, private credit behind deals.
Well, we invest across 4 different sectors: asset-light businesses and technology, business services, non-balance sheet financial services, and consumer. Our partnership orientation of investing in U.S. mid-cap and Western Europe typically involves some level of seller reinvestment. It could be a founder, a management team, or a private equity firm. And in many cases, they're reinvesting in the same transaction that they sold control to us. So it sort of moderates the purchase price. It also implies lower leverage multiples. So we don't come under stress as much, Matt, in environments like this. And to be honest with you, a fund cycle or 2 ago, I just remember in 2017, that 17 vintage, blue sky. Interest rates were 0. We did 500 add-ons. today, geopolitical strife, very difficult environment, having to be a little bit more disciplined, you can still do deals.
What do you make of a big push into retail, which, by the way, might get even bigger because the administration is talking about loosening rules for 401k? Again, you've stayed very core to what you do. Do you think some other funds have kind of been distracted is the wrong word, but kind of led astray by their big moves into retail investing, retail investors in private capital?
It certainly has become part of the alternatives universe for private equity managers. You see it less so in the medium-sized market, but it has changed the dynamic in terms of how important delivering liquidity is. So again, when we talk a little bit about BDCs and the caps on redemptions, imagine, again, if you're not returning unrealized NAV, that's a real big issue. So I think the industry average is probably 10 or 15% over the last few years, and we've been triple that. And so I think if you have retail investors, they're going to be much more focused on that.
All right, Rich, we're going to have to end it there. Thank you so much for stopping by.
Great
Lovely to see you while you're in New York. Rich Lawson of HGGC. Now, as we've been discussing, deal makers are navigating a volatile backdrop as the war in Iran continues to cloud the global economic outlook. I spoke with Gareth McCartney, UBS Global Head of Capital Markets Origination, about the potential impact on M&A.
When we came into 2026, we were expecting actually a very strong pipeline and a significant pickup in volumes. I think prior to the geopolitical concerns, that's exactly what we've seen. We've got back to the 5-year average. We're running up roughly 40% year on year. So I think strategically, we've got an investor base that's engaged in deals, and we've got corporates looking to be active. So I think the setup's pretty good. But you're right, the recent events have effectively pressed pause, but I think it's too early yet to see the real outcome.
What happens if that pause lasts for longer, though? You and I were talking the commercial break, this idea that private equity has aging assets that they have to sell. What happens if we just enter an era of more can kicking?
So I think one theme that has been very helpful to offset that this year is that fewer deals, but larger and more strategic. And therefore, if I look globally, here in the US at the pipeline, there's a group of big tech assets that could come in the second half of this year, which I think are really in their own ecosystem. So I think they will have an opportunity to come almost irrespective of the market backdrop. If you look to Europe, I think there's some themes, whether it's defense, infrastructure spending, and maybe fintech, that again are slightly insulated for broader trends. But I think there's no doubt if this is elongated and if fundamentally has a big impact on interest rates, and we see interest rates potentially rise to offset inflation threats, I think that would clearly be a major challenge for our market.
By the way, for those big tech ones, so, SpaceX, OpenAI's of the world, is there anything that can derail them? Or when you're an IPO of that size and you've been working on it for long enough, are you just inevitably going to list? Are you going to be able to find a window? Or is there something, if volatility gets bad enough, that could set them back?
I think it becomes a tactical decision. Do you want to execute in that type of environment? And maybe there's a price to pay in terms of valuation. But I think just given how sophisticated the underlying investors are, even in private in those businesses, I think they really can pick and choose their window.
What about software-related businesses? We saw some IPOs tabled to start the year. Blackstone had one. Is there still some hesitancy that if you're a business that is susceptible to any AI disruption, that maybe you rethink your plans?
I think that's right. Look, there's the key characteristics of those businesses that investors like. We have seen public markets react very quickly to the AI threat and have sold off their public holdings. That's had an impact on value and by definition has pushed out the pipeline. I think the challenge is we're going to need to see, I think, a few more quarters of numbers come through to validate the business case. I think we'll get that because I think the AI risk is further out. And then I think we'll need to take stock at that point and see what public appetite is like. But there's no doubt that the public price action is causing a pause in terms of the pipeline in that space.
And that's some of the equity capital markets. When it comes to debt, there have been some interesting things going on. JPMorgan, for example, they had to change what the debt looked like in their offering for the EA LBO. There was some pushback on a recent debt package they were bringing for a private equity buyout. What's going on in debt markets? Because there's a lot of demand for debt at this moment, but there seems to be just like touches of indigestion in certain places.
Yeah, absolutely. I think they're not immune from the software theme theme we've just discussed. We've had a market at the beginning of this year that's been very active, deep and liquid and at attractive terms for issuers. And again, I think we're just going through, similar to the equity markets, a pause, and we need to see the real impact on rates and where that comes. And therefore, I think if people have to be tactical and come, they're coming and restructuring and adjusting in price terms. But I think if you're more strategic, then I think we're waiting and we'll see where this settles in the next couple of weeks.
By the way, do any of the wobbles, I guess we'll call it, in private credit impact any of the broadly syndicate? Is there any trickle down to that?
Yeah, I think private credit is more of an indicator than a direct impact. It feels unlikely to be systemic at this point. So again, a small impact, but I think not a major impact at this point. We need to see that play out over time. And I think really from an investor base perspective, it was interesting, even in this pickup in volatility we've seen, some of the financings we were expecting, or the big sell downs we were expecting, have actually come. We did, two $5 billion plus placings in Europe over the last couple of weeks in the midst of all of this that were well received by investors. And I think debt investors are in a similar mindset. They're looking to be opportunistic, but unless they really have to commit, then they'll maybe pause for a little bit.
So what is your expectation, just to put a finer bow on things? We get back to the 5-year average, some volatility in the market. What's your expectation for how the rest of 2026 shakes out?
Look, I think you need to carve out these mega tech deals in the US because I think they're just game changers on any metric. They're larger than anything we've ever seen before, so clearly will have a big impact. My expectation, aside from that, is we'll continue to see a market that remains open, that is skewed towards larger, higher quality transactions, because I think that liquidity that it offers the investors in the secondary market gives them a little bit of comfort to offset some of the more macro challenges we're seeing. And I also think we will actually see M&A rebound and start to pick up again, and there's good appetite from public investors in debt and equity to finance and support those transactions.
That was Gareth McCartney of UBS talking about this deal environment. And catch Bloomberg Deals. That airs every Wednesday with yours truly, 12 p.m. New York time. We will have an episode tomorrow featuring David Gross from Bain Capital, a conversation you don't want to miss. Let's get a check on your equity markets an hour and a half into your trading day. And some of the gains off of the highs, but still moving higher by at least 1%. 1% for the NASDAQ. S&P goes up 1%. Yields still come in by 2.5 basis points. But part of the reason we're off the highs, look at what's happening with NYMEX crude, up 1.4%. Coming up next, Matt Miller. You might know him. Is going to be hosting Bloomberg Tech today, so please watch that. It's going to be a great show. And tomorrow in Open Interest, Cara Murphy of Kestra Investment Management, Brian Rudder of Primera, and Maria Whiteman of State Street. This is Bloomberg.